Welcome to On the Money, the video series where Wilkins Miller experts share updates, tools, and tips to help your business achieve more. Hello, my name is Sallie Byrd and I'm a manager at Wilkins Miller, and I specialize in estate, gift, and trust taxation. Estate planning had a major update under One Big Beautiful Bill, and it should change how you think about your planning strategies. Starting January 1, 2026, the federal estate and gift tax exemption increased to $15 million per person or $30 million per married couple, with adjustments for inflation each year. While the higher exemption is permanent under current tax laws can change, so proactive planning is important. Here are 5 estate planning strategies to consider right now. First, revisit your estate plan. If it's been a while since you've reviewed it, now is the time. Strategies that worked under prior exemption levels may not work for your current goals or today's tax landscape. Second, consider electing portability. Portability is when one spouse passes away, that spouse's estate can elect to transfer any remaining unused exemption to the surviving spouse. The key point here is you have to file an estate tax return to make this election. This can significantly increase the surviving spouse's exemption, especially if assets are expected to appreciate or if exemption levels decrease in the future. Third, you may want to shift your focus. With such high exemption levels right now, planning becomes less about minimizing estate tax and more about improving income tax efficiency. Optimizing basis, managing capital gains, and planning for distributions may have a greater impact now if you're under the current estate tax exemption. Fourth, consider generational planning opportunities. A larger exemption opens the door for more advanced multi-generational planning. Trust can help transfer wealth while protecting assets and maximizing long-term tax efficiency. Fifth, reevaluate gifting strategies, especially with appreciated assets. Lifetime gifts carry over original basis to the recipient, while assets held until death generally receive a step up in basis to the fair market value. Depending on your situation, holding on to those assets could result in an overall lower tax burden to those beneficiaries. The bottom line is estate tax planning is not a one-size-fits-all. What works for one person may not be the best approach for another, especially in a changing tax environment. And that was On the Money.